Hi everyone, Jeff Smith here. Today I'd like to talk about understanding behavioral biases. Are you a better than average driver? Chances are you answered yes. That's because nearly 3/4 of people think they're better than average when it comes to driving. Besides being mathematically impossible, this statistic is an example of overconfidence, and it's just one illustration of how certain biases can influence our thought patterns. In this video, we'll look at 3 of the most common behavioral biases that can impact our investment decisions. Behavioral biases can sometimes cloud our judgment and lead us to make irrational decisions. That's especially true when it comes to investing. At a time when markets are down and it's impossible to predict what tomorrow will look like, our perceptual distortions can make a difficult decision even worse. The first behavioral bias we'll cover is anchoring. You've all fallen victim to anchoring when your emotional attachment to the past value of an investment keeps you from recognizing its present value. For example, let's say you own a stock that was recently selling for $100 per share, but has since dropped to $60 per share. You may be anchored to that $100 figure, convinced that's the right value for that stock. But as a result, you may hold on to your stock convinced it will soon rebound. However, there's no guarantee that it will. Second, let's talk about recency bias. Recency bias can lead to putting too much stock and emphasis on the latest information and not taking into account other important data. For example, say stocks begin to climb and that uptick inspires a surge in buying. As more investors pile on, prices climb even higher, surpassing even historical and expensive levels. Yet, many investors may ignore this red flag, assuming the recent trend outweighs long-term data. However, bubbles like this can pop, and falling prices can potentially leave investors with losses that are even worse than they thought they could have. You can avoid recency bias by taking a long-term approach to investing. Strategies such as dollar cost averaging, where you make a series of regular investments regardless of the market's ups and downs, can help erase the temptation to chase returns or panic when the market falls. The final bias we'll look at is overconfidence. Confidence is useful, and in many cases it's necessary. Investing a chunk of your income in the stock market takes confidence. And it's confidence that allows you to keep risks in perspective and sit tight in a turbulent market environment, rather than rushing to sell your investments and locking in losses. But overconfidence can be dangerous. It can lead you to believe that you can make better decisions when it comes to investing than experts, or that you can predict market movements successfully. Here's a spoiler. You can't, and I can't. It also may cause you to feel that you can spot investment opportunities that others have missed. Worst of all, it can lead to emotional decisions in response to market moves. We know that's never good. Recognizing how behavioral influence can impact your investing can help you keep your investments in check. As a result, you may be more likely to make investment decisions that align with your long-term financial plan. It also may help you to avoid irrational decisions that might knock you off track from that financial plan. If you're seeing ways that biases have played a role or crept into your investment strategy and you'd like to chat, feel free to give me a call. We're always here to help. Thank you for joining us, and I look forward to seeing you next time.